Hello everyone. Welcome to the fundamental analysis of Best Agrolife. So let me take you through the presentation of Best Agrolife. So Best Agrolife is a high growth microcap stocks. Being microcap, it is generally more volatile and it has very less traded volumes in the market. So volatility from a theoretical standpoint is considered to be equivalent to risk. But actually volatility is a friend of an informed investor. The investors who are intelligent and informed take advantage of volatility for their own benefit. So first and foremost, there is a disclaimer that none of the stocks discussed should be construed as an investment advice. It's better for you to do your own research before taking any form of investment decision. Everything which is discussed in this particular video should be taken only for education purposes. I might change my opinion at any point in time. So let's come to the overview of the Best Agrolife. Best Agrolife has been historically an importer of um, agrochemical products, and it used to market it using its own brand. But the management has been transitioning itself from being a simple trader or importer or marketer to manufacturer, and they are also doing a backward integration of the whole molecules which they market. So management historically has been focused on products which have been in import substitutes, and they have been avoiding widely available produced in India products which have more competition. So Best Agrolife has the end user industry as agriculture. Generally, agricultural industry is a saturated industry, and the growth rate of the overall industry is not very large. It's equivalent to the real GDP growth rate approximate of our India, that is of around 8%. It grows a bit more than the the GDP. Now, Best Agrolife works on a peer-to-peer business model where they don't have their own distribution network. What they have done is they have partnered with multiple bigger companies in which they work on a margin basis. And just in order to avoid setting up their own distribution network, which would have taken a lot of time, they have done this arrangement. They claim that they are the ones who set the price, in fact, as well for these end products which goes in the market. So the distribution partners are generally the UPL, Atul, Bharat Rasayan, etc. Now let's come to the financials of the business. So this business has grown at a very rapid pace in the past 2-3 years. You can see from FY20 to FY22, the revenues have moved from 758 crore to 1316 crore. EBITDA and EBITDA margins have also improved from 4% to 14%. PAT and PAT margins have also moved from 15 crore rupees to 113 crore rupees. The PAT has moved. With the growth of revenues, you can also see that the debt and equity have moved. So there has been an equity infusion, and and obviously debt has also improved. Now, looking into these financials, there are multiple things which one has to keep in mind in the background. The first one being is that the management has done a lot of changes, and multiple companies have been acquired which were previously belonging to the promoter family, and they have been acquired or merged with this business. We'll look into its detail going forward. Now, so the revenues have increased a lot. Now comes the question, what has changed so much that suddenly this company has been increasing its revenue and margins as well? So, in the key development or the trigger point came when mm, there is a molecule which they introduced in India, dinotefuran, which in its first year itself cornered around 27% of existing market. Now, this was a big development for them. Earlier as well, this product had competition, but most of from past 6 years. But most of the companies which used to sell these products used to be importing the products from Japan and then subsequently branding and marketing in their own name. But there was no domestic supplier of this product. Now that this particular molecule, once they introduced, they had cost advantages of manufacturing, and obviously the import costs got also played an advantage. This particular and the COVID related disruptions also helped in some or the other way, because of the logistical problems which has uh, just created volatility and upward price movement in the shipping freight rates. The second one was they they have launched a molecule called ronfen, which is a insecticidal combination which can eliminate all sucking pest in one shot itself. Now, a farmer doesn't have to go and buy and mix all three insecticides. They can simply buy at a single ronfen and just use it in one shot, and they will be protected from the pests. Now, ronfen has a market potential of around 9,000 crore, which is a very big market. So this is something which has to be taken into attention, and this has helped them a lot. Now, the other thing is that, as I said earlier, the promoter group has merged multiple private entities in order to create better corporate governance. They they in order to give more confidence to the investor community, they have merged all their most of most and all of their private entities which were earlier operating in the same industry, in the same businesses. And obviously, there was a lot of inter revenues which were inter business, which was not making the whole picture clear that how the revenues and the finances are impacted in the listed entity. Recently, they have also acquired a manufacturing facility of agrico-chemicals in order to enhance capacity and will help them in manufacturing uh, products, and and um, this will be a key trigger for them to uh, to get to produce the the backward integrated products, and this will be a multi use facility which they will be having. Coming on to the balance sheet. So balance sheet is much more important than profit and loss statement. So you can see that what has happened is that from FY20 to FY22, the short-term borrowings have shot up from FY21 it was 90 crore to 217 crore. Why has it happened? Because it has gone on to finance the working capital. So you can see that the trade receivable has increased from 174 crore to 255 crore rupees. And the inventories have also shot up from 287 crore to 454 crore. Means the inventories have shot up by 167 crore rupees, and the trade receivable have shot up by around 81 crore rupees. So these two combinations have led to an increase in borrowings. Now, what generally happens is that generally the good businesses which have good brand appeal and the pull of their product, they are able to maintain lower lower inventory and and lower trade receivables. But for us microcap which is evolving, they will have to generally give some leeway so that their product is more accepted in the market by the distribution agencies and others. Although being the nature of the industry, the agri industry generally faces the problems of working capital. You can see it in the case of the in the listed rice entities or other chemical players as well who are into this agrochemical business. So the other thing is that the next fixed assets have also almost doubled, more than doubled, which indicates that the business is transitioning from being a marketer to a manufacturer of products. Coming on to cash flow is even more important. So what comes in your uh, in your in your business and what is the actual state of the cash conversion can be understood from cash flow. So in terms of cash flow, the business has had negative cash flows, which is not a very good sign. Generally, it showcases that the company is not able to convert all its profits into cash. It has to give away some parts of cash in order to keep financing the growth of the business. The other thing being the net fixed asset turnover has been declining and has come in the range about 6.7 times. Now you can see from 343, 582, 46 has come to 6.7, which showcases that the earlier the company didn't have much property, plant, and equipment on the grounds, and they were more into the trading of the chemicals. But now they are putting up the plants. Generally, the manufacturing companies have a range of somewhere in the range of from 2 times to 8 times, and there has to be a balance which has to be maintained. If if the net fixed asset turnover is very less, means that the business is very capital intensive, like cement, steel, etc. On the other hand, if it is too very high, means the business doesn't manufacture much. It relies either on outsourced suppliers, or it is basically marketing and trading other products and is not doing it in housing. Means what? It is giving away profits. So there is a scope of improvement in the business, the profits of the business, if they do a backward integration and improve the operational efficiencies and financial margins. Now receivable days is somewhere in the range of 70-80 days, which is also high. Inventory turnover is only 4 times, means the company has to maintain around 90 days of inventory, which is high, again high. So what are the summary? What is the summary? The company has a long cash conversion cycle. The If the company doesn't improve its working capital situation, it might get into debt trap, where for increasing its sales, it will have to keep on taking on short-term debt, which is also a cost to the company. Now, shareholding is an important ins- uh, indirect indirect indication of the interest of the promoters. So you can see that the promoters have been increasing their stake from 40% to 47% in a considerably short period of time. This gives a confidence to the minority investors that ours and promoters' interests are aligned. There has been a recent transaction by Mr. Um, Vimal Kumar, who is the promoter and as well as the CEO of the company. So this shows that there is skin in the game and the promoter is well aligned and considers that the business will be doing well going ahead. Now, as I had discussed earlier, so there were multiple entities of the promoters which they have more or less uh, merged or have been acquired by the listed entity, which is a good sign and gives more confidence to the shareholders. So there are some improvement areas, particularly on the employee employee satisfaction side, although the data set is too low to make any judgment, but still the company have to make some improvement in these areas, as it seems um, prima facie. Now, what is the future outlook which has been given by the company? So the management has guided for a 30% revenue growth and an EBITDA margin of 20% in FY23. Now, the EBITDA margin at present is around 14% for by FY22, and it will um, go towards around 20%. So there will be considerable operating leverage which the business will see. They will be also obviously launching innovative products with higher margins, and they will be backward integrating. They are mainly focused right now in the domestic business, but they will be building up their export business as well. The management feels so that they are going to have have export business, and they are competitive in that segment as well. Now, what has led to this particular outlook? The stock prices have shot up, have shot up recently, have shot up recently, and the the improvement in the financial parameters has made this company rise 6-7 times just in a matter of 2 years. In a matter of 2 years, the stock, the market is showing confidence at this moment to the company, and is believing that the future outcomes are going to be a future business of this company seems to be good. This this brings us to the end of this presentation. I hope you all have found it beneficial. So I hope that it has been useful for you. So thank you for watching the presentation patiently.